It's worse than I thought, and it's only going to get worse. I'm your host, Steven Van Metre, and thanks for joining me today. And markets have put in one of their worst first halves of the year in decades, despite massively bullish sentiment as investors continue to bet on a huge bear market bounce that could unwind all of these losses. But yet, stock markets continue to head lower, and based on the data we saw today, it's going to get even worse. But before we kick today's shows off, I have a special announcement to make. And for those who follow me on Twitter, you already know that Jeff Snyder and I have joined forces. That's right, he has formally resigned from his post at Alhambra Partners and has joined my firm, Atlas Financial, where he's going to resume his investment advisory practice. And we're excited to have him and all the deep knowledge of research he brings. And soon we'll be able to talk about some of these topics in more depth on his show. Now let's kick today's story off. We're head over to the Wall Street Journal. The headlines that markets post worst first half a year in decades as investors gird for more volatility. Almost everything from stocks to bonds and crypto falls to start in 2022. And global markets close out their most bruising first half of the year in decades, leaving investors bracing for the prospect of further losses. Accelerating inflation and rising interest rates fueled a months-long rout that left few markets unscathed. The S&P 500 fell 21% through Thursday, suffering its worst first half of the year since 1970, according to Dow Jones market data. Investment grade bonds, as measured by the iShares Core U.S. Aggregate Bond Exchange Traded Fund, lost 11%, posting their worst start to the year in history. Stocks and bonds in emerging markets tumbled, hurting by slower growth, and cryptocurrencies came crashing down, saddling individual investors and hedge funds alike with steep losses, leaving investors with almost nowhere to turn, but wondering when this is going to end. Well, unfortunately, it's going to end for some of those sectors, but for the rest, it's going to get worse. Now, investors seem to be in agreement about only one thing. More volatility is ahead, and that is because central banks from the U.S. to India and New Zealand plan to keep raising interest rates to try to rein in inflation. The moves will likely slow down growth, potentially tipping economies into recession and generating further turmoil across markets. And that's the biggest risk right now, which is inflation and Fed, according to Katie Nixon, Chief Investment Officer for Northern Trust Wealth. Ms. Nixon said she would be keeping a close eye on economic data to gauge how much rising interest rates are weighing on growth over the next few months. Her firm has kept money in U.S. stocks, wagering the economy will slow down, but avoid a recession. It has also put money into companies focused on natural resources, a bet that should pay off if inflation persists for longer than expected. And this is a story that you're going to see from a lot of money managers. They're going to double down on their bets on stocks. And we've covered this week in the show, talking about how some of these relationships are going to lead to lower stock prices and lower commodity prices. But watch out, a lot of these money managers are going to, like I said, double down on their bets. And if they're wrong, the losses are going to be huge. The runway for the Fed to manage a soft landing is not only narrow, but also winding and bumpy, according to Lauren Goodwin, an economist and portfolio strategist at New York Life. While household spending and corporate balance sheets look relatively strong, with something I am going to challenge today, it is difficult to see the economy avoiding recession sometime next year. Again, another thing we'll obviously challenge. This environment probably already feels like a recession for many households already. That's just the reality of it. And it doesn't feel like a recession for many households. For many households, this is a recession. Their wages are not keeping up with prices. Their money isn't going as far, and they're facing a lot of hardships due to high consumer prices. The reality is, for many households, we are in a recession. That leaves investors in a quandary. The economy isn't in an official recession, but many think it could get there in the coming year or so, perhaps even less. Investments that may have traditionally turned during sell-offs, like cash, money market funds, and treasuries, haven't held up as well this year because of inflation. And as we've talked about, the high probability that as growth goes down, that inflation is going to follow, tells us that the big story for bonds is the story to come, not the story that's been. Investors say much of their outlook for the rest of the year depends on how quickly the Fed is able to contain inflation and how much the economy slows as a result. And that's the hope. The belief is if the Fed can bring inflation down at a rate that is comfortable, that all of a sudden the market is going to boom. And the part that people are missing here is not that the economy can't go farther and can't expand. The problem we have is the Fed is pulling liquidity out of the markets, and that's starting to bring asset prices down. We see that in the equity market. market. We see in the crypto space. Real estate is to come, and you bring asset prices down enough, and you start to find out, well, where all the bad apples are. Where is all the rot in the system? And this is what happens during financial crises when central bankers bring asset prices down, and all of a sudden things start to break. We haven't gotten to that point yet, but more prices go down, the closer we get, and let's just hope we don't get there, because if we do, it's going to be ugly. And there's a lot of uncertainty, I think, that's really reflected in the market volatility. And well, here it is. It's about to get worse, and I want you to see that it is going to get worse. And we've already talked about some of this with the regional Fed data, but here's more of the official data as U.S. manufacturing growth weakens to two-year low as orders slump. According to Bloomberg, the Institute for Supply Management's gauge decreased to 53 last month from 56.1 in May. Now, keep in mind that readings above 50 indicate an expansion. So when we see 53, how do you interpret that? It means the economy is expanding at a slightly faster rate than last month. So when you think about what's going on in the economy, it's slowing down, it's decelerating, the pace of growth is slowing, and then all of a sudden what next usually happens is it rolls over and starts to contract. That's when we look for numbers under 50. Projections had the survey at 54.5, missing completely. So the group's index of new orders. Now this is key because we talked about new orders driving the economy. Remember, we talked about the Dallas Fed survey data this week, and new orders are critical. If retailers have too much inventory, they start cutting orders and eventually start cutting staff. Well, here we see new order data. What is it telling us? It dropped 6 points to 49.2, a slight contraction, the poorest result from May of 2020, and when the economy was digging its way out of a pandemic-induced recession. Shrinking orders come as consumer spending slows under the weight of inflation and inventories pile up. The ISM gauge of manufacturer inventories ticked up to 56, near the highest reading since 2010. So what are we seeing here? New order demand going down, that's not bullish for the economy, and inventory levels rising. Also not bullish for the economy, because now what is it telling you as a consumer? What does that mean for demand? Well, demand is going away as, of course, financial conditions tighten. The results are consistent with several regional Fed Reserve surveys, which we talked about this week, that show a clear pullback in June factory activity. Gauges of manufacturing in Texas and the Fed districts of Philly and Richmond dropped to the lowest level since May of 2020. In a sign that supply chains and capacity constraints appear to be easing, ISM's measure of delivery times and backlogs both declined in June to the lowest level since 2020. And here again, because we don't have data on the ISM in the Fed database, I can't show you this. But when you see those two things, such as supplier delivery times and backlogs start to fall, that's telling you that inflation is going to come down. Because if I'm a manufacturer and I have a big backlog in things I need to bill for customers, well, that's going to put pressure on higher prices. But as that backlog shrinks, well, that's telling me demand's falling, and so too will inflation. Meanwhile, the Purchasing Managers Group of Production Index climbed to a 4-month high. And for a third straight month, a gauge of prices paid by producers declined, suggesting costs of raw materials are starting to ease. However, the index remains elevated and concerns about high petroleum prices linger. But one thing we do know, as prices paid come down, what does that mean for bonds? Well, it means interest rates are about to fall and bond prices are about to rise. Now, if you're concerned at all what all of this could mean to your portfolio as we face another recession, well, you shouldn't be. I'll put a link up here to Portfolio Shield, a strategy that actually understands the dynamic of bonds during a recession and hedges with them. I'll put a link in the description below. And this is one of the reasons that Jeff came over, because he wanted to endorse and be behind a strategy that followed along with his research and beliefs in the market, and this is it. All right, let's continue on. Because cooling consumer spending points to further economic slowdown, as we see here from the Wall Street Journal, as household spending in May rose at its slowest rate this year, as some economists see second straight quarterly contraction. Well, they're about to get it. As consumer spending cooled to a 0.2% advance in May, the Commerce Department said on Thursday. And that was the smallest monthly gain this year and down from the revised 0.6% increase in April. The Federal Reserve's Bank of Atlanta closely watched GDP Now tracker has estimated, not as of Thursday, but as of today, minus 2.1% for the second quarter, which would squarely put the economy in a recession. Thursday's report showed after-tax inflation-adjusted income declined by 0.1% in May, indicating that wage increases are struggling to keep up with price increases, something we've talked quite a bit about on the show. Inflation-adjusted spending declined by 0.4% in May, and real or inflation-adjusted disposable personal income is now at minus 3.3%, telling us we aren't just almost in a recession, we are in a recession as consumer spending is going to slump against higher prices. And consumers have financed their purchases by saving less, and in May, the savings rate rose modestly to 5.4% after the rate fell to its lowest level in more than a decade. And this is the rate where experts or Fed economists believe is the excess money that people have after all their bills to invest. And when money to invest goes down, well, markets tend to follow. They are spending down roughly the $2 trillion in excess savings that accumulated during the height of the pandemic when spending fell and the government stimulus padded bank accounts. And here you can see the personal savings rate in blue at a very low level and the Wilshire 5000 Price Index in red on a year-over-year rate of change. And notably, when we start to get into periods where the personal savings rate is relatively low, particularly after a boom in the market, you'll notice the year-over-year rate of change in the markets fall because there just isn't enough money to prop up asset prices. And that's why you see things like stocks, bonds, Bitcoin, and everything else coming down. Consumers are spending above their normal levels, but not because their incomes are well above normal levels, but because of their savings and their desire to put things on credit cards. My guess is Labor Day, most of this excess savings will be gone, and that's bad news for the economy. As Americans are spending more on energy, as we've talked about, they're pulling back elsewhere while also attempting to use less fuel. In the first full week of June, gasoline sales by volume in the U.S. stations were down by 8.2% compared with the same week last year, indicating that consumers are going to be forced to spend less, and that's going to mean disinflation is coming. And then we find out that the recession probability soars as inflation worsens. As economists see interest rate increases, raising the likelihood of recession to 44% in the coming 12 months. As a surveyed by Wall Street Journal now says the probability is 44% in the next 12 months, a level usually only seen on the brink or during actual recessions. And this is perhaps a topic for my friend Jeff and I will talk about on Emil's channel, on their show, Eurodollar University, where we may actually find out that a recession isn't just a year away, it's likely coming this year. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.